Hello, I'm Shayla.
And I'm Scott. This video will discuss the types of securities that you can invest in.
A security is a financial instrument that holds some type of monetary value. Stocks, bonds, and ETFs, or exchange-traded funds, are all examples of financial instruments and securities.
Securities are all part of different asset classes. Remember, asset classes are groups of investments with similar characteristics.
Stocks, bonds, and cash are considered traditional asset classes. But even within each asset class, there are multiple types of securities. It can be helpful to think about the different types of securities from a company's perspective.
When a company issues securities to fund its operations or growth, those securities make up the company's capital structure. You can think of a company's capital structure like a puzzle. There are lots of different securities or puzzle pieces, and each one has a different shape or different characteristics. It's important to keep in mind that not every company issues all types of securities, just like different puzzles will have pieces with different shapes.
Let's start with equities. There are two main types of equity securities: common stock and preferred shares.
Common stock provides the holder of the stock with an ownership share in a company and may also give the holder the right to vote at company meetings.
Preferred shares are like common stock in that they give the holder ownership in the company. But holders of preferred shares have a higher claim to the company's dividends and assets than holders of common stock.
While there aren't very many types of equity securities, there are many different types of bond or fixed income securities.
The first type of bond security we should talk about are government bonds. These bonds are issued by governments instead of companies, so they are not a part of capital structure. Most government bonds make fixed-rate coupon payments, but some government bonds are structured to adjust these coupon payments based on inflation. These securities are called inflation-protected bonds and are a different type of security than regular government bonds.
The government isn't the only group that can issue bonds. Companies can issue their own bonds as part of their capital structure, which are called corporate bonds. Corporate bonds are usually divided into specific security types based off of the credit rating of the company and any specific terms attached to the bond.
Investment-grade corporate bonds are those assigned higher ratings by credit rating agencies because they are believed to have a lower risk of default. Investment-grade bonds are rated BBB or higher.
Corporate bonds with credit ratings of BB or below are called high-yield bonds. These bond securities offer higher coupon rates to attract investors since they are riskier than investment-grade bonds.
Like government bonds, the price of most investment-grade and high-yield corporate bonds changes as interest rates change. To protect against these price changes, some companies issue bonds that adjust their coupon rates if interest rates change, so that the prices of their bonds don't change because of interest rates movements. These securities are called floating rate loans.
Think of these securities like a fishing boat in the ocean. If the boat is trying to catch fish that live at a certain depth, the fishing line needs to be longer when the boat goes over a big wave or if the tide is high. When the tide is low or the boat is between waves, the fishing line needs to be shorter in order to keep the bait at the same depth.
In our example, the length of the fishing line is the coupon rate on a floating rate loan. It moves higher or lower with interest rates so that the price, or in our example, the fish, remain unaffected.
The biggest risk for the corporate bond securities we've talked about so far is whether or not the company is able to pay each coupon and repay the principal when these bonds mature. Companies make these payments with the profits from their operations. Some companies will issue bonds that pay interest based off of a pool of specific assets or loans that they've made instead of from their operations. These bonds are considered to be secured by this pool of assets or debts, and they're called securitized debt.
Some bonds issued by corporations that mature in the very near future are considered very safe investments, and by many investors, they can be treated as the equivalent of cash. Examples include term deposits and commercial paper. These securities make up money markets and are often collectively called money market securities. They are known for being quite safe, but offering fairly low rates of return over time relative to stocks or bonds.
As you can see, there are a lot of different types of bond securities. There's even a type of security called a convertible, which is a hybrid of an equity and a bond. Convertible securities are bonds or preferred shares that pay interest or dividends that can be converted into common stock in the company at a future date.
We've talked a lot about securities issued by companies as part of their capital structure, but there are also securities that are created for investments and other purposes that are not a part of capital structures.
One example of these types of securities is derivatives. Derivatives are securities whose value is based on a different asset. Some types of derivatives include futures, options, and structured notes. Derivatives are generally more complex securities, so we'll talk about them more in a separate video.
One popular example you may have heard of are ETFs, or exchange-traded funds, that can invest in many other securities. ETFs can be considered securities because they are listed on exchanges.
We've spent a lot of time puzzling today, and hopefully now you have an idea of all the different puzzle pieces that you can use to build your own investment portfolios. There are lots of different securities that you can choose in asset classes, from stocks and bonds to money market securities, convertibles, derivatives, and ETFs.
Thanks for joining us today. Make sure to follow along with our other videos to learn more about investing.